Today, we're diving into one of the most influential books in personal investing, A Random Walk Down Wall Street by Burton Malkiel. In this episode, we'll explore the ideas from Chapter 1, where Malkiel takes us through the early history of financial bubbles and what they reveal about human behavior in markets. Everything we discuss today comes directly from this chapter summarized, interpreted, and paired with modern insights to help us better understand how markets really work. Let's get started. Okay, so to kick things off, Burton Malkiel. He seems like the perfect guide for this journey, right? What makes his perspective so valuable here?
Yeah, absolutely. What's really striking about Malkiel is that he comes at this from, well, multiple angles, not just one. He actually brings three distinct viewpoints together.
Three.
First, he's got serious experience as a Wall Street professional. I mean, he started out as a market specialist at a major investment bank, and he was chairman of the investment committee for a big insurance company, even a director at a huge global investment firm. So he has this practical, indispensable perspective on how things really work day to day. It's not just theory for him.
That hands-on experience must be crucial. What's the second angle?
The second is his academic side. He's a highly respected economist, chaired investment committees, done specialized research on markets, investor behavior, all that stuff.
So he knows the research inside out.
Exactly. He's got that deep knowledge of, the academic findings and how to evaluate investment opportunities from that rigorous standpoint.
And the third?
Well, this one's maybe the most compelling. For many people, he's actually been a successful investor himself.
So he practices what he preaches.
He does. And he has a bit of fun with it, joking that academics aren't really supposed to make money, that knowledge is the goal. But the fact that he's done well personally definitely adds weight to his advice.
That combination is pretty powerful, isn't it? Wall Street insider, academic expert, and successful investor. It makes sense then that the book feels aimed at, well, regular people interested in their finances.
Totally. It's written for financial laymen, as he puts it, offering practical, tested advice. You don't need a background in finance, just, an interest in making your investments work better for you.
Okay. And one of the first things he does is draw a line in the sand, right, between investing and something else.
Yeah, a really crucial distinction, investing versus speculating. His definition of investing is pretty clear. It's buying assets to get reasonable, predictable income, dividends, interest, maybe rent, plus, hoping the asset itself grows in value over a relatively long time.
How long is long?
We're talking years or even decades. It's a long-term game.
Okay, so that's investing. How does speculating differ then?
Speculating is all about the short term, buying something because you think you can sell it for a profit very quickly, maybe in days or weeks.
Gotcha. So this deep dive, like the book itself, isn't really for day traders looking for hot tips.
Definitely not. He states up front it's not for speculators. It doesn't promise any get-rich-quick schemes. He even quips that maybe getting rich steadily would be a better subtitle. It really sets the expectation for a patient, considered approach.
Makes sense. Let's get to the core idea then, the random walk. What does that actually mean in the context of the stock market?
Okay, so the random walk concept is basically saying that future stock price movements, well, they can't be reliably predicted based on past prices or trends.
So knowing what happened yesterday doesn't really help you know what will happen tomorrow.
In essence, yes. Short-term fluctuations are, for all practical purposes, unpredictable. And this is where it gets quite controversial.
How so?
Because the implication is huge. It suggests that a lot of the tools people rely on, investment advisors, detailed earnings forecasts, complex chart patterns, might actually be, well, useless for predicting those short-term moves.
Useless. Wow.
Yeah. He uses that famous analogy, the blindfolded monkey throwing darts at the stock listings in a newspaper.
Yeah, I've heard that one.
The idea is that the monkey's random portfolio would likely perform just as well as one carefully picked by experts. It's a bit provocative, obviously, but it hammers home the point about the unpredictability of short-term market direction.
I can imagine that didn't go down well with the professionals. That's basically challenging their entire value proposition.
Oh, absolutely.
Yeah.
It kicked off a grand battle, as he calls it. Market professionals pushed back hard, defending their methods like fundamental analysis.
That's looking at the company's health, earnings, that sort of thing.
Right. And also technical analysis, which is all about studying past price charts and trading volumes to find patterns. They argue these can predict future prices. We'll get more into those later, as the book does.
And what about the academics? How did they react?
Well, the academics sort of doubled down and refined the theory into what's called the efficient market hypothesis. It comes in like three flavors: weak form, semi-strong and strong form, each suggesting different levels of information are already baked into stock prices?
Making it harder and harder to beat the market.
Pretty much.
Mm.
They also developed this new investment technology, things like beta to measure risk, and more recently, smart beta, though Malkiel seems a bit skeptical about that last one.
So a real fight then.
A real tooth and nail fight, yeah. Because, there are big interests at stake. Academics are looking for tenure, recognition. Professionals are chasing bonuses, protecting their reputations. It's a fundamental clash.
Okay, shifting gears slightly but staying practical, let's talk inflation. Why is just holding cash such a bad idea over time?
Well, simply put, inflation eats away at the value of your money. If your cash isn't earning returns that are at least keeping pace with the rate of inflation, you're actually losing purchasing power year after year.
It's like a silent tax almost.
Exactly. Investing becomes essential just to stay level, just to preserve the wealth you already have.
And those examples of inflation's impact over time are quite striking, aren't they? The newspaper price multiplying, 49 times?
Yeah, between 1962 and 2014, with average inflation around 4%, and the Hershey bar going up 20 times in price and shrinking.
Right, shrinkflation too. It really shows how even moderate inflation adds up dramatically over the long haul.
It really does. And while some analysts might be forecasting low inflation now, Malkiel warns against getting too comfortable. He points out that productivity growth isn't uniform across the economy.
What do you mean?
Well, think about service industries. It's hard to make a string quartet more productive, right? You still need 4 musicians or a surgeon performing an appendectomy.
True. Technology might help around the edges, but the core service takes time and skill.
Precisely. So if wages in those sectors rise, and they tend to cost, the cost will likely go up too. This creates persistent upward pressure on prices, meaning we probably shouldn't rule out faster inflation down the road.
So the takeaway is, even if inflation feels low, you absolutely need a strategy to make your money grow faster just to maintain your standard of living. Ignoring it is, well, a recipe for getting poorer slowly.
It really is. Which brings us back to the need for investing. But, and this is important, he stresses that investing does require some effort.
It's not just set it and forget it entirely.
Not quite. He mentions that story from Chekhov's play, The Cherry Orchard. The Ranevsky family loses everything not because of some catastrophe, but just through sheer neglect, not knowing how to manage their assets.
Okay. So even if you use an advisor or a fund, you still need to understand enough to choose wisely and monitor things.
Exactly. You need to know how to pick the right help for your situation.
But it's not all serious warnings and effort, is it? He also mentions that investing can actually be fun.
Yeah, he does. There's the intellectual challenge, matching wits with the market. There's the satisfaction of seeing your investments grow, maybe even outpacing your salary increases.
And learning about new stuff too, new technologies, new companies.
For sure. You end up learning about all sorts of innovations and trends just by paying attention to where your money is. He sees successful investors as often being quite well-rounded, curious, intelligent, and willing to put in the effort. It can be genuinely engaging.
Okay, let's dive into the actual methods professionals use. He talks about 2 main traditional theories for valuing assets, right? They sound almost like opposites.
That's right, the firm foundation theory and the castle in the air theory. And he says understanding both is really key to making smart decisions and, maybe more importantly, avoiding big mistakes. They represent 2 fundamentally different ways of thinking about value.
Let's start with the firm foundation one. What's the core idea there?
The basic idea is that every investment, a stock, a bond, whatever, has an underlying intrinsic value, like a solid foundation. And you can figure out this value through careful analysis of its prospects, its earnings, dividends, and so on.
So you do the math, find the true worth.
Pretty much. And the strategy follows from that. If the market price drops below that calculated intrinsic value, that's your signal to buy. If the price goes above it, you sell, because you expect the price to eventually come back down to reality, to that firm foundation.
Who came up with this? Or who really refined it?
Well, S. Eliot Guild gets some credit, but John B. Williams is seen as the one who really formalized it in his book, The Theory of Investment Value. He developed a practical formula based on future dividends.
Dividends, okay.
Yeah, and the key concept he used was discounting. It sounds complex, but the idea is simple. Money you expect to receive in the future is worth less than money you have today.
Because you could invest today's money and earn a return on it.
Exactly. So $1 promised next year might only be worth, say, 95 cents right now. You discount future earnings back to their present value. This idea, championed also by economist Irving Fisher, is now standard practice.
So the logic is solid. A stock's value depends on the cash flows, the dividends it's expected to generate over its lifetime, and how fast those grow.
That's the theory. But, and here's the big but, the crux of the problem, as Malkiel puts it.
Uh-oh.
It all hinges on making accurate predictions about the future growth rates, how long that growth will last. And that's incredibly tricky.
Right, predicting the future is hard.
Extremely. When markets get really optimistic, analysts sometimes joke about discounting the afterlife because the growth assumptions become so stretched. So that firm foundation might not be quite as firm or as easy to pinpoint as the theory suggests. It still involves a lot of guesswork about the future.
Yet this approach has been hugely influential. People like Benjamin Graham and David Todd, their book Security Analysis was like the Bible for generations of analysts.
Absolutely. And most famous, most successful practitioner is probably Warren Buffett, the sage of Omaha. His entire career is largely built on this firm foundation value investing philosophy.
Okay, so that's one side. What about the complete opposite, the castle in the air theory? Sounds much less grounded.
It is. This theory shifts the focus entirely away from intrinsic value and onto psychology. John Maynard Keynes, the famous economist who was also a very successful investor himself, really articulated this back in 1936.
Keynes, what was his take?
He argued that most professional investors aren't actually trying to figure out the true long-term value of a company. Instead, they're focused on figuring out what the crowd is going to do next.
Like predicting mob mentality?
Sort of. They try to anticipate how public perception and sentiment will build these castles in the air, periods of optimism where prices get bid up and the smart investor gets in before the crowd fully builds the castle, ready to sell when enthusiasm peaks.
And Keynes actually did this. I heard he traded from his bed for half an hour each morning.
Apparently so. And quite successfully made millions for himself and massively grew the endowment for King's College, Cambridge. So he definitely walked the talk on this approach.
So what's the underlying logic? If it's not about future dividends, what is it about?
Keynes explained it in his big book, The General Theory. He said, look, nobody really knows what future earnings will be. So investors spend their time trying to predict what changes will occur in the generally accepted basis of valuation. In other words, what story will the market believe next? What will catch the crowd's fancy? It's about psychology, not financial analysis.
That leads to his famous analogy, doesn't it? The beauty contest.
Exactly. The newspaper beauty contest. It illustrates the point perfectly.
How did that work again?
Okay, imagine a newspaper runs a contest with pictures of 100 faces. To win, you don't pick the face you think is prettiest. You have to pick the 6 faces that you think most other contestants will pick as the prettiest.
Ah, so you're guessing what everyone else will guess.
Precisely. And the really clever players take it a step further. They think about what other people are likely to think other people will choose. It becomes this game of anticipating mass psychology, layers deep. That's the castle in the air idea in an extreme form.
That sounds kind of cynical. Is this related to the greater fool theory?
It's very closely related, yes. The greater fool theory is just a harsher name for it. It basically says an investment is worth whatever you can convince someone else, the greater fool, to pay for it.
So fundamentals don't matter, only the expectation of selling higher.
In that view, yes. No price is too high, the thinking goes, as long as someone else is likely to be willing to pay a higher price. It's all about momentum and finding the next buyer.
And we still see echoes of this today, right?
Oh, definitely. Think about Robert Shiller's work on irrational exuberance, explaining bubbles like the dot-com boom through mass psychology. The whole field of behavioral finance has grown up around this, looking at how psychological biases affect our financial decisions. Daniel Kahneman won a Nobel Prize for work in that area.
Right.
And Oscar Morgenstern, another Nobel winner, was quite dismissive of finding intrinsic value, comparing it to fishing in the water or looking for fish on a tree, basically saying it's futile. He summed up this whole psychological view with the Latin phrase, res tantum vale quantum vendi potest.
Which makes
A thing is worth only what someone else is willing to pay for it. Simple as that. Value is purely subjective and determined by the market's mood.
Wow. So 2 completely different ways of looking at the world. One is all about calculated intrinsic value, the numbers. The other is all about psychology, the crowd, the story.
Exactly. And what's fascinating here is how these theories, developed so long ago, they still capture the fundamental tension in markets today. It really is a constant tug of war between that objective analysis or attempted objective analysis and the power of collective psychology. That dynamic shapes so much of what we see.
So what does this all mean for you, the listener? If investing has all the elements of a dramatic climax, including the creation and loss of huge fortunes and these classic arguments about why it all happens, how will you use this understanding to navigate your own path down Wall Street?
In this video, we'll explore the key ideas from Chapter 2. We're really getting into some fascinating history here, looking at speculative bubbles and this idea of the madness of crowds. And we'll definitely be unpacking the concept of building castles in the air.
Yeah, and understanding these past frenzies, it's just so important for anyone investing today, isn't it? The lessons about, well, human psychology and how markets behave, they really are timeless. You know, Gustave Le Bon pointed this out way back. He said that in crowds, it's often stupidity that accumulates, not common sense.
That's a sobering thought.
It is. And when markets shoot up purely on that kind of psychological support, well, financial gravity eventually takes over. Prices can stay sky high for a surprising amount of time, sure, but the fall, it can be like an earthquake. Sudden, dramatic.
So this castle in the air idea, why are we so drawn to it? Why does greed, seem to trump logic so often?
It seems baked into us, doesn't it? The castle in the air theory really helps explain it. Essentially, people stop buying for intrinsic value. They buy because they hope, or maybe they believe, someone else, a greater fool, will pay even more down the line.
So it's less about the asset, more about the next buyer.
Exactly. And you see this pattern again and again. .com bubble, other recent surges. The psychology is the same. The second your main reason for buying is predicting what someone else will pay, you're building that castle. But trying to guess when the music will stop, when to get out, well, that's incredibly risky. Very dangerous game.
Which brings us perfectly to our first big example. Tulip mania in 17th century Holland. You picture this calm, prosperous place, right? Then a botany professor brings in these rare tulips from Turkey. But the real spark, apparently, was when someone stole some bulbs, sold them, and actually made money. That got people thinking.
And then there was this weird twist with a virus, a mosaic virus. It didn't kill the tulips, but it created these amazing patterns, these flames of color on the petals. Suddenly, these weren't just tulips, they were strange bulbs, highly sought after. Public taste just zeroed in on them. The weirder the pattern, the higher the price.
Right, so it wasn't even about a perfect flower anymore. It was about the beautiful flaw, the rarity.
Precisely, the rarity caused by the virus.
And from there, it just took off. The merchants started trying to predict trends, hoarding bulbs, expecting prices to keep climbing. And they did, skyrocketed. It got to the point where the higher the price, the smarter the investment seemed. Charles Mackay wrote about this, how everyone got involved. Noblemen, farmers, sailors, maids, even chimney sweeps. They all thought the tulip craze would last forever.
And the financial system adapted, didn't it? They came up with ways for more people to play. Early versions of call options. You could pay a small premium, maybe 15–20% of the bulb's price, for the right to buy it later at a fixed price. If the price jumped, you exercise the option, buy low, sell high. Huge potential gains from a small initial outlay.
So basically leveraging up your bet.
Exactly, which opened the door for lots more people, but of course massively increased the risk involved.
There's that crazy story about the sailor, right? Helps illustrate just how valuable these things became.
Well, yeah, the sailor, just off his ship, grabs what he thinks is an onion from a merchant's counter to eat with his herring.
An onion.
An onion. Turns out it was an Admiral Leifkinshoek tulip bulb, worth a fortune, enough to feed a ship's crew for a year, supposedly. The merchant was less than pleased, had the poor guy thrown in jail. It really shows the almost absurd value people placed on these things.
He really does. Now, I know some historians, like Peter Garber, have argued there was some logic behind it all.
That's true. Revisionists like Garber point out that rare bulbs were already expensive before the peak mania, and they didn't become completely worthless afterwards. They retained some value.
Okay, so maybe not total insanity, but still, how does that explain prices multiplying 20 times over in a single month, like January 1637, and then crashing just as fast in February? That seems like more than just market fundamentals adjusting.
I agree. It's hard to square that speed and scale with pure rationality. Eventually, prices got so high that some sensible people started selling. And once that started, panic, the snowball effect. Everyone rushed for the exits at once.
And the government couldn't stop it.
They tried, put out statements, tried to restore confidence, but nobody listened. Deals collapsed, people went bankrupt. Prices just kept falling until most bulbs were worth less than actual onions. Classic case of financial gravity kicking back in.
Okay, let's shift gears. Imagine this. Your broker calls, super excited. New company, amazing prospects, no sales yet, no profits.
Uh-oh. Sounds familiar.
Right. And when you ask what they actually do, he says, nobody knows. But hey, you make a ton of money. Seems like an obvious scam today, maybe. But that's pretty much the story of the South Sea bubble in England. A classic tale of fraud and greed.
And the context in England then was, well, perfect for it. They'd had a long period of prosperity, people had savings, but not many places to invest them. Owning shares was actually quite prestigious, even a way for women to own property. So the South Sea Company pops up in 1711. Its official purpose was managing government debt, but it also fed this huge public appetite for investments, promising big profits from trade with South America.
And the insiders cashed in right away, didn't they? Buying up cheap government IOUs and swapping them for company stock at full value. Meanwhile, their actual trading efforts were, well, disastrous. Failed slave trading voyages with horrific death rates. They seemed way more focused on hype than actual business.
And you have to see this alongside what was happening in France with John Law's Mississippi Company. Law had this grand vision of using paper money to boost the economy. He built this company into a massive conglomerate. Its share price went through the roof from 100 francs to 2,000. They literally invented the word millionaire during that boom. Its value was supposedly 80 times all the gold and silver in France.
Wow. And that success in France, it sort of lit a fire under people in Britain.
Definitely. There was a kind of national rivalry. Why should France get all the action? The South Sea Company became Britain's champion, especially when news broke that the war with Spain might end, opening up trade. People had these fantasies of Mexicans eagerly trading gold for British wool. Pure optimism, totally misplaced.
So the company seized the moment.
Absolutely. In 1720, they made this incredibly bold offer to take over the entire national debt, all 31 million pounds. The public loved it. The stock price jumped from £130 to £300 almost overnight when the plan was announced. And, naturally, political supporters got rewarded. Free shares handed out, including to the king's mistress, which they could flip for instant profit.
And that just fueled the fire even more, right? More share issues.
Wave after wave. They made it easier and easier to buy in. New shares at £300, easy installments. The king bought £100,000 worth. Price hits £550. Another issue. Even easier terms, 10% down, pay the rest in a year. Price shoots to £800. You had half the House of Lords, more than half the Commons involved. The price peaks at £1,000. Unbelievable.
But even that wasn't enough to soak up all the speculative money floating around.
No way. Investors were hungry for the next big thing, so promoters jumped in, launching all sorts of new companies. These became known as bubble companies, and their business plans got more and more ridiculous. Importing Spanish donkeys, extracting sunshine from cucumbers.
Sunshine from cucumbers? Seriously?
Seriously. Making lumber from sawdust. Just wild, often fraudulent schemes, nearly 100 of them, all promising massive returns.
And people bought into it.
Hook, line, and sinker. The most famous story is the guy who launched a company for a most advantageous undertaking, but no one knows what it is. Promised huge profits. Opened the books at 9 a.m. Total chaos, people fighting to get in. He collected money from 1,000 investors in 5 hours, then just disappeared, vanished to the continent, pockets full.
Incredible. Which brings us back to that greater fool idea.
Exactly. It's crucial here. A lot of these investors weren't necessarily idiots. They didn't always believe in, cucumber sunshine. But they did believe that prices would keep going up, and they could always sell their shares to someone even more gullible, an even greater fool for a profit. In their own minds, it made perfect sense. It felt rational.
Until it didn't. Were there warning signs?
Subtle ones, like those playing cards making fun of the bubble companies. But the real trigger was internal. The South Sea Company's own directors knew the share price was totally detached from reality. So over the summer, they quietly started selling off their own shares, cashing out.
And when that got out,
Boom! The price collapsed, panic set in. The government tried to step in, but it was too late. Total crash. Which is when Isaac Newton supposedly made his famous comment, "I can calculate the motion of heavenly bodies, but not the madness of people."
perfectly sums up the whole castle in the air phenomenon.
It really does. Okay, those are fascinating historical stories, but they were centuries ago. Surely things are different now. Could that kind of madness happen in, say, the 20th century?
Well, let's jump to the U.S. in the Roaring '20s. Unprecedented prosperity. Calvin Coolidge famously said, "The business of America is business." Businessmen were like heroes.
And the stock market became the place to be. Absolutely. By 1928, it was a national obsession. The gains were incredible. I mean, the market gained as much between early 28 and September 29 as it had in the entire 5 years before that. Stocks would jump 10, 15% in a day. A British journalist noted how everyone in New York, no matter what they talked about, eventually ended up talking stocks and got deadly serious about it.
And this was also an era of pretty blatant market manipulation, right? These things called pools.
Oh, completely widespread. Pools operated almost openly. Take Radio Corporation of America, RCA. A pool drove its stock up 61% in just 4 days.
How did they even manage that?
It was quite sophisticated in a crooked way. A group of traders would collude, led by a pool manager. They'd quietly buy up shares, maybe get options for more. Critically, they'd often get the stock specialist on board, the person on the exchange floor who handled the orders for that stock. That specialist had the book, they could see all the buy and sell orders, huge advantage. Then they'd start wash sales.
Wash sales.
Yeah, pool members trading shares back and forth among themselves, pushing the price up with each trade. It looked like heavy, exciting volume on the ticker tape machines across the country.
Creating a buzz, basically.
Exactly. Add in some fake tips, maybe some positive press releases, timed just right by company insiders, and the public piles in. Once enough ordinary investors bought in at the inflated prices, the pool operators would, as the saying went, pull the plug on the bathtub, quietly sell all their shares, make huge profits, and leave the public holding the bag as the price collapsed.
Wow. So it wasn't just groups. Individuals could play this game too.
For sure, especially insiders. Look at Albert Wiggin, head of Chase Bank, a huge bank at the time. In July 1929, what does he do? He shorts his own bank's stock, over 42,000 shares.
He bet against his own company.
He did, and he timed it perfectly. Chase stock tanked, and he personally made millions from the decline. Talk about a conflict of interest. Today, that's highly illegal for insiders, but back then, different world.
Okay, so the market peaks September 3rd, 1929. What happens next? The Babson break.
Right. September 5th. Roger Babson was this financial advisor who'd been warning about a crash for ages. People mostly laughed at him. But that afternoon, his prediction gets quoted on the ticker tape, and boom, the market dives. Big names, AT&T, Westinghouse, U.S. Steel, all dropped sharply in the last hour. His moment finally arrived.
Did that shake confidence immediately?
It definitely wobbled through September. Lots of down days, despite officials and bankers saying everything was fine. You even had Professor Irving Fisher from Yale, a respected economist, famously declaring stocks had reached a permanently high plateau. He even tried to argue prohibition was making workers more productive, justifying the prices.
Permanently high plateau. Famous last words.
Pretty much. By late October, things were getting tense. October 21st, prices fall, triggering margin calls. People who borrowed to buy stocks had to put up more cash or sell. Selling pushed prices down further, triggering more margin calls. A vicious cycle. Trading volumes surged. The ticker tapes couldn't keep up, which just added to the fear.
Leading to Black Thursday.
October 24th. Massive turnover. Almost 13 million shares. Prices just gapped down. $5, $10 drops between trades. Some stocks lost 40, 50 points an hour. President Hoover came out saying the fundamental business of the country is on a sound and prosperous basis, trying to calm nerves.
But it didn't work. Then came Black Tuesday.
October 29th, 1929, the big one. The most devastating day in NYSE history up to that point. Over 16 million shares traded. Prices just fell off a cliff, almost vertically. By the time the market finally bottomed out in 1932, it was carnage. Most blue chips down over 95%. Even AT&T, seen as safe, lost 3/4 of its value.
Just brutal.
Yeah. Variety, the showbiz paper, had that classic headline, "Wall Street lays an egg." Summed it up perfectly. Billions wiped out, millions of people ruined, and of course it ushered in the Great Depression. Again, some historians argue maybe monetary policy played a role, that there was some logic, but fundamentally those late 20s gains just weren't sustainable.
And you mentioned there's specific evidence of just how irrational things got. Something about closed-end funds.
Ah, yes. That's a fascinating piece of evidence. Closed-end funds own a basket of stocks, right? And normally, historically, they trade at a discount to the actual market value of the stocks they hold. Maybe 10, 20% less?
Because of fees, or maybe they're harder to sell.
Exactly. But in 1929, from January to August, these funds traded at an average premium of 50%. Think about that. People were paying $1.50 for $1 worth of underlying stocks. Some funds were even wilder. Goldman Sachs Trading Corporation traded at twice its asset value. Tricontinental Corporation hit 256% of its value.
So you could buy AT&T stock directly. or pay 2.5 times as much to own it through this fund.
Precisely. That's not rational investing. That is pure, unadulterated speculative fever. Buying simply because you think the price will go higher, ignoring the fundamentals completely. Clear evidence of irrationality.
Looking back at all this, tulip mania, the South Sea bubble, the 1929 crash, what's the big takeaway for listeners today? It feels like these things just keep happening in different forms.
They really do. Bernard Baruch, the famous investor, said studying this history is crucial for market survival, and he was right. Making money in markets isn't necessarily the hardest part, believe it or not. The real challenge is resisting that powerful temptation, that lure of the quick buck during speculative booms. It looks so easy, so tempting.
Siren's song.
That's a good way to put it. It's a lesson history teaches again and again, but each new generation seems determined to ignore it.
So maybe the final thought for everyone listening is this. As you navigate the markets today, with all the noise and excitement around certain trends or assets, how do you spot when you might be starting to build your own castle in the air? How do you resist that pull, especially when everyone else seems to be caught up in it, and stick to a more grounded long-term view? Something to definitely think about. In this deep dive, we'll explore the key ideas from Chapter 3. Get ready to join us on a fascinating journey through financial history. We're going to unpack why even, seemingly rational markets can sometimes go absolutely wild. And it's not just individual investors getting caught up, is it? Even seasoned professionals get dragged along for the ride.
Oh, absolutely. It's truly astonishing when you look back at the extent of, collective market madness. You'd think that professional portfolio managers, the ones handling huge sums in pension funds, mutual funds, advisory firms, they'd be immune, right? Immune to the kind of speculative fever that grips the general public.
Yeah, you'd expect a certain level of detachment, of cool-headed analysis.
But here's the central paradox. These institutional investors haven't just participated in major speculative waves, they've often led them. And it wasn't usually because they saw deep fundamental value. No, it was more about anticipating that a greater fool would come along and buy at an even higher price.
Ah, the greater fool theory. Buy high, sell higher, regardless of what the thing's actually worth.
Exactly. That idea where you buy simply because you believe someone else will pay more, it's a powerful and, frankly, often dangerous force in the markets.
Okay, let's unpack this. A good place to start seems to be the roaring 1960s. This era had what people called a new era, right?
Right.
Marked by this growth stock and new issue mania.
Mm.
The word growth itself almost took on this mystical quality. You had companies like IBM, Texas Instruments, real innovators, sure, but trading at absolutely astronomical price-to-earnings ratios.
Yeah.
Like 80 times earnings, sometimes even more. And just for context, a typical healthy PE might be, what, 15 to 20?
Yeah, maybe 15 to 20 is sort of normal, depending on the industry. So 80, that's investors paying for 80 years of current earnings for one share. An incredible bet on future growth. A bet that, let's be honest, very few companies can ever actually deliver on. And it's quite striking how, back then, if you dared to question those sky-high valuations, you were practically seen as, a heretic. Like, you just didn't get it. The belief was just so strong. Even if current prices couldn't be justified by fundamentals, the feeling was, someone else will eagerly pay even more tomorrow. It's like the economist John Maynard Keynes and his idea of building castles in the air in the stock market. He would have seen this coming.
Building castles in the air. That's a great way to put it.
The core lesson, really, is that a compelling story, no matter how flimsy the foundations, can temporarily just completely override rational valuation.
I've heard stories from that time, too. You had older investors, people who actually remember the 1929 crash, being super wary of these stocks. They wouldn't touch them. But it was the ambitious, maybe less scarred, younger crowd driving the market. There's that quote from a broker back then, something like, speculators thought whatever stock they bought would double overnight. The terrible thing was, it actually happened.
Yeah, that's the dangerous part, when the irrationality gets temporarily validated.
And it got even crazier, didn't it?
Well,
With the whole tronics boom, companies would just vaguely tack the word electronics onto their names. Didn't matter if they had anything to do with electronics. People just didn't seem to care what the company did, as long as the name sounded sort of techie and cool. Like American Music Guild, they just sold records door to door. They changed their name to Audiotronics. Stock launches at $2, and boom, it hits $14 in weeks.
That's a perfect example. It really highlights the absurdity, like that famous story from Jack Dreyfus. He talked about this small, established shoelace company, right? Trading at a perfectly reasonable 6 times earnings, solid little business. But then it changes its name to, get this, Electronic Silicon Firth Burners Company, Inc.
Birth burners, what even is that?
Exactly. Dreyfus joked that electronic and silicon alone were instantly worth a 15 PE multiple in that market. But the real kicker was firth burners. Nobody knew what it meant, and apparently a word nobody understands was worth doubling the PE ratio.
Doubling it.
Yeah. So you take the shoelace PE of 6, add 15 for electronic, and silicon gets you to 21. Then double it for firth burners. Suddenly, your shoelace company is trading at 42 times PE.
That's just madness. Pure fantasy, dressed up as innovation.
Pretty much.
And the sad reality, of course, was that a decade later, most of these tronics firms were worthless, vanished.
They just disappeared, which raises the question.
Where was the oversight? What about the SEC?
That's a vital question. Where is the SEC, the Securities and Exchange Commission? Well, they did require companies to prepare compliant prospectuses, and those prospectuses often had these bold warnings, things like, this company has no assets, no earnings, cannot pay dividends, highly risky.
Like the warnings on cigarette packs, basically.
Exactly like that. But just like those warnings, they couldn't stop determined speculators. The SEC could warn the fools, but they couldn't prevent them from, squandering their money. What they could do, and did, was crack down on outright fraud and market manipulation, especially by some of the sketchier brokerage firms involved. But the key lesson from the tronics boom is just how fast a new concept, even a vague one, can sweep up investors. Appearance often trumps reality in these frenzies.
So the tronics boom fades out around 62. But Wall Street needs its next fix, right?
Yeah.
By the mid-60s, there's a new magic word, synergism. This became the big idea behind the conglomerate wave. The promise was that 2 plus 2 could somehow equal 5 after a merger.
Yeah, synergy. And it's fascinating how they went about achieving this supposed synergy. Antitrust laws made it hard for big companies to buy competitors in their own industry. So they started looking outside, buying companies in totally unrelated fields.
Okay.
And the growth they showed, it was often presented as this great benefit of the merger. But really, the driver was often just financial engineering, pure accounting tricks. Conglomerate managers got really good at manipulating earnings per share rather than actually improving the businesses they bought.
How did they do that?
Well, they'd exploit accounting rules or, more commonly, the difference in PE multiples. Take Abbott Circuits, an electronics company with a high PE. It acquires Baker Candies, a low PE company. By swapping stock, Abbott essentially buys Baker's earnings cheap at Baker's low multiple and then sells them to the market at Abbott's own high multiple. Boom, instant earnings per share growth, even if neither business got any better.
Wow. Okay, so it's paper growth, not real growth. There was a real-world example, right?
Yeah.
Automatic Sprinkler Corporation, later Figge International. Their sales grew like 14 times between 63 and 68, purely through acquisitions, buying low PE companies using that trick.
Yeah.
And the market loved it. Their PE shot up to over 50 times in 67.
Oh, yeah. And the CEO, Mr. Figge, he was a PR genius. He'd talk about freeform energy and core technological fulcrums, this whole new language that just baffled and impressed investors.
Baffled is probably the right word.
Totally. Nobody really knew what it meant, but it sounded incredibly sophisticated. Zinc mines became aerospace minerals divisions. Steel mills were materials technology divisions. If an analyst asked how a foundry could grow 15-20% a year, they'd get some story about efficiency experts and new markets. And the crazy thing, the PE ratios of these conglomerates actually rose with all this merger activity.
Until the music stopped, which it always does.
Always does.
January 19th, 1968. Litton Industries, a huge conglomerate name, suddenly announces earnings will be way lower than expected. This was a company that had grown earnings like clockwork, 20% a year for nearly a decade. So the news hit like a ton of bricks. Shock, disbelief.
And then the selling started, a total frenzy. Conglomerate stocks just plummeted like 40%.
Ouch.
Looking back, two big things came out of that phase. First, investors finally clued in that managing these sprawling, unrelated empires was incredibly hard. The whole 2 plus 2 plus 5 idea, clearly false. Some even started wondering if 2 plus 2 still equaled 4.
Right. The complexity caught up.
And second, the government and accounting bodies, the FTC, the SEC, got seriously concerned about how these mergers were happening. That led to regulatory changes making the earnings growth game much harder to play. And quick historical footnote, fast forward to the early 2000s, and the trend completely reversed. Deconglomeration, spinning off subsidiaries, became the hot strategy to boost value.
Interesting how things swing back and forth.
The lesson, though, is that financial engineering can only hide the cracks for so long before reality bites back.
So conglomerates fall apart. What's next? Mutual fund managers needed a new mantra, and they found it. Performance.
Yeah.
This kicked off the concept stock bubble. Simple idea.
Yeah.
Make your fund stocks go up faster than the other guys and you attract more money.
Yeah.
All about rapid appreciation.
Exactly. And some funds had incredible, if brief, success. Remember the Enterprise Fund, Fred Carr ran it, delivered a massive 117% return in 1967.
Wow.
That fueled the rise of these go-go funds and their managers, the aggressive young gunslingers, they called them. Fast trading, high risk. They chased dynamic stocks with really compelling stories, shifting capital quickly to the next big narrative. And the appeal wasn't necessarily that the story was true, it was the belief that other people would believe it and drive the price up.
Keynes again. Believing what others believe.
Precisely what he talked about back in 1936. Still relevant.
My favorite story from this era has to be Cortez W. Randell and his company, National Student Marketing Corporation, NSM. This guy was a character, master of self-promotion. Had a white Learjet called Snoopy, fancy apartment castle in Virginia, a yacht.
Living the high life.
Totally. Wrote a book, did anti-drug ads, projected this image of a super successful, dynamic entrepreneur. And his concept, NSM could cater specifically to the booming youth market. Like the conglomerates, NSM grew through acquisitions. But everything he bought was somehow tied to college kids, posters, records, summer job directories, you name it.
It's all about the story, right? And then you get the really extreme examples, like Mini Pearl. Started as a fast food franchise company, changed its name to Performance Systems purely to appeal to those performance-chasing investors.
Performance systems, not subtle.
Not at all. And at its peak in 1968, this company had zero earnings, none, which gave it an infinite PE ratio.
Infinite PE. How does that even...
Think about it. You're paying an unlimited amount per dollar of earnings because there are no earnings. You are buying nothing but pure hope. Or maybe pure delusion.
So why did these concept stocks blow up so spectacularly in the end? Well, first, those ridiculous PE ratios. If a PE drops from, say, 100 down to a more normal 20, that's an 80% loss right there.
Yeah, the math is brutal.
Second, lots of them ran into serious operational problems. They expanded too fast, took on too much debt, management lost control. The founders often weren't great operators.
Storytellers, not managers.
Exactly. And third, unfortunately, there was just plain fraud. Cortez Randell himself ended up pleading guilty to financial fraud.
Right.
So the lesson seems to be the danger of investing just based on a sexy story or a charismatic leader with no real substance or profits underneath.
It seems like a cycle.
It really does. After the craziness of the 60s bubbles, Wall Street pros in the 70s basically took a vow, okay, enough of that, back to sensible investing. Out went the concept stocks. In came the blue chip companies. The idea was, you know, these giants like IBM, Xerox, McDonald's, they won't collapse like those speculative plays. You could just buy them and, I don't know, sleep at night.
And that led straight to the Nifty 50 craze. About 50 high-quality, big, well-known growth stocks. Household names. The thinking behind it was multi-layered. One, they seemed safe. Two, institutions could buy large amounts without moving the price too much because they were so big. Three, the belief was, okay, maybe the price is high now, but their amazing growth will eventually justify it. And four, maybe most importantly, the security blanket effect.
Security blanket.
Yeah. Nobody would fire a fund manager for buying IBM, right? If IBM went down, well, everyone lost money on IBM. It wasn't seen as some reckless gamble. It was the safe, prudent choice, even at a high price.
But the flaw, the big fallacy, was that these same institutional investors just ignored the math again. No company, doesn't matter how great, can grow fast enough forever to justify an 80 or 90 PE ratio. It was just foolishness, dressed up as wisdom again. How does that keep happening, that collective suspension of disbelief?
It's often that social proof, you know, the comfort of the crowd. If all the other smart professionals are doing it, it must be okay. And, like all these speculative episodes, the Nifty 50 party had to end. It was the very same institutional managers who first loved these stocks who eventually woke up and realized, whoa, these are way overpriced. They started selling, and that led to a major crash for these former darlings. The premium just vanished.
So even the best companies aren't immune to becoming bubbles.
Absolutely not. When valuations detach completely from reality, even quality doesn't save you from the eventual fall. The lesson? Price always matters.
And here we go again. The early 1980s. New issue mania rages again. It's almost like a rerun of the 60s, isn't it?
Yeah.
Just swap out tronics for new buzzwords like biotechnology and microelectronics. In 1983, the total amount raised from new stock issues, IPOs, actually exceeded the combined total for the entire previous decade.
The market was just ravenous for IPOs again. Anything new and exciting. You had some really quirky examples preparing to go public, like Androbot planning to make robots for your home, and a New Jersey company called Stuff Your Face, Inc. Yes, they only had 3 restaurants, but they were getting ready for an IPO.
Stuff Your Face, Inc. Seriously.
Seriously, the demand was just there for anything with a story.
And then there was that truly bizarre case, Fine Art Acquisitions. This wasn't just some fast food joint. It was pitched as this highbrow artistic venture. Their prospectus actually listed a collection of nude photos of a very young Brooke Shields as a major asset.
I remember that. Unbelievable.
Her mother obviously was not happy, sued, got the photos back. The company changed its name later and eventually failed anyway. Just, wow, stranger than fiction.
It really is. And looking at the whole picture of that early 80s new issue boom, it seems like the offering that might have finally popped the bubble was Muhammad Ali Arcades International.
The boxer.
Yeah. The offering itself wasn't that different from other junk issues, but it had this unique structure. A share of stock and 2 warrants, all for just 1 penny.
A penny.
A penny. A warrant, remember, gives you the right to buy more shares later at a set price. Anyway, the turning point seemed to be when people found out that Muhammad Ali himself hadn't bought a single share of the company bearing his name.
Ooh, that doesn't look good.
Not at all. It made investors pause and actually look at what they were buying across the small cap sector. And they didn't like what they saw. That whole sector tanked. Many investors lost like 90% of their money in just a year.
Ouch. Another brutal lesson.
The lesson?
Mhm.
Celebrity names and hype might inflate things for a while, but if there's no substance, gravity eventually takes over.
Okay, so from new issues in general to a specific hot sector, the 1980s also gave us the biotechnology stock bubble. You mentioned it felt like the Tronics boom.
Very similar vibe, absolutely. The optimism around genetic engineering was just huge, off the charts. Genentech was the poster child. When they went public in 1980, the stock almost tripled in the first 20 minutes of trading.
20 minutes.
20 minutes. Analysts were forecasting billions in sales for drugs like interferon, even though the reality, years later, was much, much lower. They kept predicting earnings would explode and kept being wrong.
So if there were no earnings, minimal sales, how on earth did they value these companies?
Well, they had to invent new ways. There was this thing called the product asset valuation method. It basically involved estimating the future value of all the products the company had in the pipeline, even if a product was literally just a sketch on an engineer's notepad.
You're kidding. Valuing napkin drawings.
Essentially, yes. Valuing potential sales, potential profit margins of ideas that barely existed. It was pure speculation on future breakthroughs.
Were people just ignoring the obvious potential problems? Like, what about FDA delays? Or could the market even afford the super high drug prices they expected? Patent fights, profits going to big pharma partners.
In the mid-80s frenzy, it seems those concerns just vanished. Poof. I remember one analyst actually arguing that biotech stocks were less risky than traditional drug companies.
Less risky. How?
His logic was, and I quote loosely here, biotech companies have no old products whose sales are declining to offset.
That's insane. Having actual sales and profits is a disadvantage.
Complete inversion of logic. Of course, reality hit eventually. Most biotech stocks ended up losing 3/4 of their value or more.
Wow.
The takeaway there is crystal clear. Valuing pure potential, especially in complex new fields without any tangible results, is just asking for a speculative disaster.
And maybe the ultimate cautionary tale of the 80s, the one that sums up the excess and, frankly, the potential for outright deception, has to be the ZZZ Best Company bubble. Barry Minkow. It was pitched as this incredible American dream story, right? Kid starts cleaning carpet, becomes a millionaire by 18. Horatio Alger stuff.
Oh, Minkow's story was amazing on the surface. Started cleaning carpets at 10, company at 15, millionaire by 18. He knew how to create an image. Red Ferrari, mansion with a Z in the swimming pool, wrote a book called Making It in America, even did anti-drug commercials. Total self-promoter.
And he told Wall Street his carpet cleaning company was bigger than IBM in its field, the General Motors of carpet cleaning.
And people bought it. Investors listened, incredibly.
Until the shocking truth came out. ZZZ Best wasn't just cleaning carpets. It was a massive front.
Yeah, a huge money laundering operation and a classic Ponzi scheme. Fake contracts worth millions, totally fabricated credit card charges, just shuffling money around, scamming you investors to pay off old ones.
And Minko himself was accused of pocketing millions.
Right. In 1989, he was only 23, but he got convicted on 57 counts of fraud, sentenced to 25 years in prison, ordered to pay back $26 million. The judge had some harsh words, called him a dangerous man because of his glib tongue and ability to communicate, and added, "You have no conscience."
But the story gets even weirder, doesn't it? He supposedly finds religion in prison, gets out, becomes a pastor, writes more books, even consults for the FBI on fraud detection. Looked like a total redemption arc.
Looked like it, but unfortunately it wasn't real. In 2011, he was convicted again for securities fraud, then again in 2014 for embezzling $3 million from his own church.
Unbelievable. Some people just don't change.
It seems that way. The ZZZ Besk saga is just this stark reminder that even sophisticated investors can be completely fooled by a charismatic personality and audacious lies, especially when greed gets in the way of due diligence. #tag lessons from history and global context.
Okay, so we've walked through the 60s, 70s, 80s, these waves of speculation. What are the big lessons we can pull from all this history?
Well, I think the clearest lesson, looking across all these examples, is just how crucial popular perceptions and investor psychology are in setting stock prices. Often, it seems completely separate from the underlying fundamentals, the actual value of the business. This is where that castle in the air theory really comes alive. You're not valuing the castle's foundation, you're betting on how impressive it looks to the next person. And that makes investing, at times, a remarkably dangerous game.
So for you listening, the practical advice seems pretty clear. Be really careful with those hot new issues, those IPOs. The data generally shows most IPOs actually underperform the wider market over time. And if you buy them after they start trading, you're probably paying an even higher premium.
That's right.
Remember, the people selling you those shares are the company insiders, the management. They often choose to sell when things look brightest, either for the company's development or just when investor excitement is absolutely peaking.
Good point.
So just following the crowd into these hot areas, even if the industry seems exciting, can end up being just unprofitable busy work. It's this recurring human thing, isn't it, getting swept up?
It really seems to be hardwired.
And it's not just a U.S. phenomenon, right?
Yeah.
These speculative bubbles pop up everywhere. We should probably touch on Japan's bubbles in the late 20th century.
Oh, definitely. Japan's experience was, in some ways, even more extreme. It shows these forces aren't confined by borders. Let's talk real estate first. Between 1955 and 1990, land prices in Japan rose over 75 times. 75?
That's hard to even comprehend.
The numbers are just staggering. By 1990, Japan's total real estate value was estimated around $20 trillion. That was over 20% of the entire planet's wealth at the time.
$20 trillion.
Get this, the U.S. is 25 times larger geographically, but in 1990, Japan's land was valued at 5 times all U.S. real estate combined. People seriously theorized that Japan could sell Tokyo and buy the entire United States, or that the grounds of the Imperial Palace in Tokyo were worth more than all of California.
That sounds completely insane, like bubble logic defined.
Pure bubble logic. And the stock market was just as wild. It climbed like a rocket up 100 times between 1955 and 1990.
100 times.
At its peak, in December 1989, Japan's stock market cap hit $4 trillion. That was almost 1.5 times the value of all U.S. stocks and nearly 45% of the entire global stock market.
Yeah.
One country.
Wow.
Investors who focused on, rational value were just completely bewildered.
Yeah.
PE ratios in Japan soared past 60 times on average. Stock prices were nearly 5 times their book value. Dividend yields were minuscule, like 200 times earnings.
Compared to the US PE of maybe 15 at the time.
Exactly. And individual companies, even more outrageous. NTT, the big telecom company, its market cap was bigger than AT&T, IBM, Exxon, GE, and GM combined.
One Japanese company worth more than 5 American giants put together. How did anyone justify that?
Well, the Japanese securities industry, their version of Wall Street, had plenty of explanations ready. Were the PE too high? No, they'd say. It's actually undervalued. Japanese companies depreciate assets too much, and we don't count income from affiliates properly.
Okay.
Dividend yield under 0.5%. Oh, that just reflects Japan's super low interest rates. Price 5 times asset value. Not a problem. Book value doesn't capture how much the land they own has appreciated.
So they had a convenient story for everything.
Always a story. But critically, those explanations just didn't hold water under scrutiny. Even with adjustments, the PEs were way higher than anywhere else and higher than Japan's own history. Company profitability was actually falling, the strong yen was hurting exports, and while land was expensive, Japanese firms were finding cheaper factory sites overseas. Plus, rents weren't rising nearly as fast as land prices, meaning real estate yields were collapsing.
So the foundations were cracking.
Definitely. And then the trigger. Those low interest rates that fueled the boom started to rise in 1989. The Bank of Japan got worried about inflation, tightened credit, raised rates, hoping to gently cool things down.
But bubbles rarely cool gently, do they?
Almost never. There was no soft landing. The stock market completely imploded. The Nikkei index peaked near 40,000 in late '89. By mid-1992, it was down around 14,300, a drop of about 63%.
63%. That's almost as bad as the Great Crash here in the U.S. from 1929 to 32.
Very comparable in severity. And right alongside the stock market crash in the early 90s, that enormous real estate bubble burst too, with similar declines. It completely shattered the myth of Japan being somehow unique, of ever-rising asset prices. It just dramatically proved that the law of financial gravity, it doesn't care about geography, it applies everywhere.
A universal lesson indeed. Hashtag tag outro.
Unchecked speculation, fueled by appealing but ultimately flawed narratives, always eventually runs into economic reality.
So wrapping this up, what's the core takeaway from this deep dive into historical bubbles for you, our listener?
I think understanding these patterns is just so crucial for trying to recognize similar things happening in today's markets. It really hammers home that point that even the pros, the institutional investors, can get caught up in that greater fool game, buying not on value, but on the hope someone else pays more later.
Absolutely. And that leads us right to a final thought, maybe a provocative question for you to ponder. What new magic words are floating around today? What new concept stocks or maybe even asset classes might be building fresh castles in the air right now? And perhaps more importantly, how can you better equip yourself to spot them? How can you think critically about the investment stories you hear instead of just getting swept along with the tide? Food for thought. In this video, we'll explore the key ideas from Chapter 4. Today, we're taking a deep dive into two financial super bubbles from the early 21st century, the dot-com bubble and the housing bubble. We're going to unpack the sheer scale of wealth created and then, well, utterly destroyed. We'll explore the surprising psychology that fueled these things and, maybe most importantly, distill the crucial lessons you can take away for your own financial life.
Right. And these weren't, just minor market blips. These were huge events that reshaped whole economies. They fundamentally challenged how we think about value and risk. Honestly, comparing them to something like the tulip mania, it almost feels like an insult to tulips given the colossal impact. The dot-com burst, for instance, wiped out something like, an estimated $8 trillion in market value. That's like several major European economies just vanishing overnight.
Wow.
And the housing bubble, that nearly took the entire global financial system down with it. It was that serious.
Okay, let's get into it. The dot-com era first. What made this bubble so unique? How did it even kick off?
Well, bubbles often spring from something new, right? Groundbreaking technology, or maybe a revolutionary business opportunity. The internet was this really potent combination of both. It promised to change everything, how we get information, how we shop, connect, everything. And this double whammy created just an unprecedented surge of wealth, but then just as quickly, an equally unprecedented destruction of it.
Yeah, it really sounds like a runaway train.
Yeah.
Robert Schill talks about these positive feedback loops.
Yeah.
Can you sort of walk us through how that actually played out in the dot-com craze?
Absolutely. So imagine the price of internet stocks starts to just creep up a bit. That rising tide encourages more people to buy in, which then gets more media attention, right? Which draws in even more buyers. And those early investors, they're making easy money. They tell their friends at parties how simple it is to get rich, driving prices higher and higher, pulling in more and more people. It's almost like a greater fool game, or maybe even a Ponzi scheme, really. You constantly need new, arguably more gullible investors to buy from those who got in earlier, and eventually, you just run out of greater fools.
And it wasn't just small investors, right? Even the biggest players on Wall Street got caught up in it. I remember hearing about Goldman Sachs, this venerable firm,
Yeah.
claiming that the massive cash burn of these internet companies was just an investor sentiment issue, not a real long-term risk. What happened just a few months later?
Exactly. Hundreds of internet companies went bankrupt, which ironically proved Goldman's report kind of correct, but in a very immediate, short-term way. The cash burn wasn't a long-term risk for them because, they didn't exist in the long term. And back then, anyone who dared to question this new economy was immediately shut down, called an anti-technology Luddite,
The numbers themselves really show how detached things got. The NASDAQ index, it more than tripled in just over a year. And PE ratios, price to earnings for companies that were actually profitable, they soared past 100 times earnings. What did that mean for a company like Cisco, say, at its peak?
Okay, Cisco, a core internet backbone company, right? Its PE was in the triple digits. Its market cap was heading towards $600 billion. Now, even if Cisco's earnings grew by a phenomenal 15% every single year, its PE ratio would still be way above the market average a decade later.
Still.
Yeah. And if it kept up that 15% annual return for 25 years, its market cap would eventually be bigger than the entire U.S. economy.
It's just not possible.
It was simply unsustainable. It highlights that, look, growth alone is enough. You need sustainable profit potential. That's the real key.
And we're seeing echoes of that today, aren't we, like with NVIDIA, often called the king of AI infrastructure. What do its valuations look like right now, say mid-2025?
Indeed. The pattern, it does seem to repeat. NVIDIA's PE in 2025 is somewhere between 60 and 70 times earnings. And its market cap is nearing $4 trillion. That's almost the size of the entire German stock market.
4 trillion.
Right. Now, if it managed 15% annual profit growth, which is huge, by the way, its PE would still be above average in 10 years. And if you project a 15% annual return for 25 years, its market cap hits $13.3 trillion.
Which is just astronomical.
It would require it to grow faster than the entire global economy. It's a valuation that's become, completely untethered from any reasonable expectation of real earnings growth. When that sustained high growth doesn't materialize, even a divine stock like NVIDIA could face potentially a 90% valuation compression, just like Cisco did.
Right.
People won't say NVIDIA was a bad company, of course. They'll just remember that everyone scrambled for an AI golden ticket at a $4 trillion market cap with a 70x PE ratio.
So, okay, beyond just having a potentially good idea, what else were companies doing to jump on this bandwagon? I heard about companies just adding .com to their names.
Oh, it was wild. Absolutely wild. Just like the Oldtronics craze decades before. Companies, even ones barely connected to the internet, they just changed their names. Slapped on .com or internet. There was actually a study that found companies doing this saw their stock prices jump 125% more than similar companies just in the 10 days around the name change announcement.
125% just for a name change.
Yep. Even companies with basically no core internet business saw their stocks surge, of course. Most of these eventually became worthless.
But it got even more absurd than that, right?
Yeah.
Tell us about Palm Pilot and 3Com. That story is just unbelievable.
It really goes beyond simple irrational exuberance. So 3Com owned Palm Pilot, okay? They decided to spin it off, give shares to existing 3Com shareholders. Here's the crazy part. Palm Pilot's stock soared so high that its market cap reached twice that of its parent company, 3Com.
Wait, the part was worth double the whole company.
Exactly, which meant that 3Com's other businesses, its core networking business, were essentially valued at negative $25 billion.
Negative $25 billion. How is that even possible?
Mathematically, you could buy 3Com stock and get their other businesses for, like, minus $61 per share.
That's just broken.
The market was creating anomalies more bizarre than any accounting fraud you could imagine.
It sounds like it was just a playground for venture capitalists, too. What
Well-
kinds of, outlandish ideas actually got funded back then?
Oh, the money was flowing like crazy. In just the first quarter of 2000, you had over 900 VC firms pouring, $15.7 billion into more than 1,000 internet startups. A lot of them were just chasing trends, no real business model. We saw companies like DigiSense. They wanted to make websites emit smells.
Emit smells. Seriously.
Or Flues, this alternative email currency that got tangled up in a scam with stolen credit cards, despite their buy a dollar for 80 cents pitch.
Doesn't sound sustainable.
Not quite. And Pets.com, famous for its sock puppet mascot, right? But couldn't make money delivering low-margin dog food. There was even a website called stupidcompany.com that just chronicled all the failures. It got millions of visitors. And the utterly foolish swapit.com. They tried to profit by actually handling the inventory of junk people wanted to trade online. The complete opposite of eBay's successful, hands-off model.
I also heard a particularly wild story about theglobe.com.
Ah, yes. Theglobe.com. Founded by two young guys in a Cornell dorm room. Basically an online message board, hoping to sell banner ads. Now, 5 years earlier, a company with no real revenue, no profit, would never have had an IPO. Never.
Right.
But in November 1998, their stock goes public at $9 a share. And it immediately shoots up to $97.
$97.
Yep. made it the most profitable first-day listing ever at that time, pushed the company's market cap close to $1 billion. The founders became instant elites. One of them famously said he was ready to live a disgustingly frivolous life with girls with money. This IPO was a real trigger. It basically severed the link between profit and stock price. It opened the floodgates for countless other loss-making companies to go public. TheGlobe.com, by the way, closed its website in 2001. You had John Doerr, this huge venture capitalist, calling the whole era the greatest legal creation of wealth. He conveniently forgot to mention later that it was also the most devastating legal destruction of wealth.
And who else was fanning these flames? I imagine the Wall Street analysts, the ones who became household names, played a pretty big role.
Oh, absolutely. Mary Meeker, Queen of the Net, Henry Blodgett, King Henry, Jack Grubman, the telecom stock guru. These analysts were paid millions, but not really for the quality of their analysis. It was more about their ability to attract lucrative investment banking business for their firms.
Ah, the conflict of interest.
Exactly. The Chinese walls meant to separate research from investment banking. They became more like Swiss cheese, just riddled with holes. Blodgett argued traditional valuations didn't apply to explosive growth. Meeker famously said, "Now is the time to be rationally reckless."
Rationally reckless.
Yep. They even used baseball terms like 4-baggers and 10-baggers for stocks, all hype.
And they almost never recommended selling a stock, did they?
Almost never. The buy-to-sell ratio was nearly 100 to 1. You had Americans watching prices just climb and climb, thinking investing was easy money. But when the bubble burst, these celebrity analysts faced lawsuits, investigations. Blodgett became the clown prince of the bubble. Grubman was ridiculed for hyping WorldCom.
So beyond just the hype, how did they even try to justify these sky-high valuations? They must have invented some bizarre new metrics.
Oh, they did. They certainly did. In this fearless new internet world, things like sales, revenue, profit, suddenly irrelevant. They looked at eyeballs, just the number of people browsing a web page, or intending customers, defined as anyone who stayed on the site for at least 3 minutes.
3 minutes. That makes you an intending customer.
Apparently. Mary Meeker even praised drugstore.com because 48% of its eyeballs were intending customers. Nobody cared if they actually bought anything. Drugstore.com's stock peaked at $67.50. A year later, when profit mattered again, it was a penny stock.
Wow. That really shows how important it is to stick to fundamentals when people start dismissing traditional valuations.
It's often a huge red flag, right? Not some new paradigm.
Customer mindshare was another one of those buzzwords, wasn't it? That sounded equally crazy.
Yes. That was the one that convinced a lot of people that investors had truly, lost their minds. Like homestore.com, highly recommend it because apparently 72% of internet users' time spent on real estate sites was on their listings.
Okay.
But customer mindshare didn't actually lead to property sales. Their stocks still plummeted 99%. For telecom companies, they measured miles of fiber optic cable laid, not how much data was actually flowing through it. PSINet even painted its name on a football stadium.
Just pure marketing.
Pure marketing. They just kept lowering valuation standards as prices rose, leading to this massive oversupply. Get this. A $1,000 investment in Nortel Networks stock just a year before the fall of 2002 was worth only $49. Meanwhile, if you'd spent that same $1,000 on Budweiser, drank it all, and recycled the cans, you would have gotten $79 back.
That says it all, really.
By late 2002, that Nortel investment was worth just $3.
The media played a huge role, too, didn't they?
Yeah.
So turning us into a nation of stock traders.
Definitely. The news industry, like any industry, follows supply and demand. Investors wanted internet news nonstop. So magazines like Wired, The Industry Standard, Business 2.0 just proliferated, all promising easy wealth. Jane Bryant Quinn called it investment pornography.
Strong words.
And the internet itself, it democratized access to stock info, real-time data, analyst tips, news, which just kept feeding the bubble.
And the online brokerages were pushing it hard, too. I remember those commercials vividly. They were everywhere.
Oh, yeah. Advertising heavily, promoting low fees, though, often with hidden costs, right? One ad had this woman boasting she'd wrestle its skinny little body to the ground and make it beg for mercy, talking about beating the market.
Oh, my goodness.
Another showed some guy in a post office telling his boss, just buy this stock. And the boss, knowing nothing, just buys 100 shares. It fueled just unprecedented stock turnover. People held stocks for days, sometimes just hours. Daily price swings for top stocks often exceeded 50%.
And you had something like 10 million day traders supposedly quitting their jobs to chase this quick wealth. Long term for them meant what later that morning?
It was truly insane. People would spend hours agonizing over buying a $50 kitchen appliance, but then risk tens of thousands of dollars based on advice from some anonymous online chat room.
What did the actual data show about how successful these day traders were, and how long did they typically last?
The research was pretty overwhelming. Most day traders lost money, and the more they traded, the worse they did. On average, a day trader only lasted about 6 months before blowing up.
6 months. Wow. And finally, of course, this kind of environment seems absolutely ripe for fraud.
Speculative manias almost always bring out the worst in people. Corporate management often started aiming to satisfy the immediate demands of speculators, not build long-term value. They'd use creative accounting, let's call it what it is, often fraud, to hit these aggressive earnings targets Wall Street wanted to see. Enron is the quintessential example.
Enron.
Once the seventh largest U.S. company, it collapsed spectacularly, losing $65 billion in value.
Enron was seen as the perfect new economy stock. Right?
Yeah.
What were some of their most, well, egregious tricks?
They created these incredibly complex partnerships, these special purpose entities, basically to hide their true financial health, hide debt off the balance sheet. One simple example. They formed a joint venture with Blockbuster. It failed. But Enron secretly partnered with a Canadian bank, which then lent Enron $115 million against the JV's future profit.
Lent the money against profits that didn't exist.
Essentially. And Enron recorded that loan as current profit. Their CFO made something like $30 million managing these supposedly independent partnerships. Arthur Anderson, their auditor, even signed off saying the books fairly presented the company's condition. Clearly not the case.
Unbelievable.
There was even this scam within the scam where the top execs, Ken Lay and Jeff Skilling, set up a completely fake trading room just to impress Wall Street analysts who visited. They bought top-of-the-line equipment, had employees pretend to be making trades, even painted phone lines black on the walls to look busy.
They faked a trading floor.
They did. Both Lay and Skilling were later convicted of conspiracy and fraud. One Enron employee who lost everything famously sold T-shirts with let's just say, a very crude and angry message directed at the executives.
And Enron wasn't an isolated case, was it?
Yeah.
This was more widespread.
Not at all. Telecom companies were exaggerating revenues by basically swapping fiber optic capacity with each other, trades that generated no real cash flow. Tyco used cookie jar reserves.
What are those?
It's a sneaky accounting trick. You stash away earnings in good years so you can dip into the cookie jar to artificially boost profits when times are leaner. Makes earnings look smoother than they are. WorldCom inflated profits by $7 billion just by reclassifying routine expenses as capital investments, pushing costs into the future. You had CEOs acting like chief embezzlement officers, CFOs like chief fraud officers. There was even a dark joke that EBITDA actually meant earnings before I trick the dumb auditor.
Wow. It's just hard to believe so many people fell for all this.
Well,
Looking back, what's the main takeaway for you from the whole dot-com bubble?
I think we just should have been far more discerning. History shows us again and again, right? Even hugely transformative technologies, railways, airlines, television, didn't necessarily make the early investors rich. The key isn't just societal impact or even industry growth. It's whether the industry and the specific companies in it can actually generate and sustain profits. All these excessively prosperous markets, they eventually succumb to gravity. Making money in the stock market isn't that hard over the long term. It's avoiding the irresistible temptation of these short-term get-rich-quick schemes that's really, really difficult.
So if you had to point fingers, who are the main villains here? Or is it more complicated?
Look, you could definitely point to the brokers pushing junk stocks, the analysts who became cheerleaders just to win investment banking deals, the corporate executives cooking the books. But maybe the main reason the bubble inflated so much was that individual investors were just susceptible. Susceptible to that contagious greed, the allure of easy money, the fear of missing out. I had a friend, right, built a solid, diversified portfolio over years. But he kept going to cocktail parties, hearing about friends tripling, quadrupling their money in internet stocks.
As FOMO kicked in.
Totally. He wanted some of that excitement. He bought into boo.com, remember them? Online fashion retailer trying to sell clothes no one was wearing yet at full price.
Oh, dear.
Time and Fortune had hyped it. Morgan Stanley invested millions. He got hooked, bought near the peak, and lost everything when the company burned through $135 million in 2 years and went bankrupt. Avoiding those kinds of terrible mistakes. That's probably the single most important factor in preserving and growing your capital over time.
Okay, so the dot-com bubble was this huge stock market spectacle. But the early 21st century had another crisis brewing, one that maybe hit even closer to home for the average American, The housing bubble. This wasn't just about stocks changing hands. It felt like the very foundation of the financial system shifted almost overnight. Can you explain that fundamental change that sort of set the stage?
That's a really critical point because for most people, their home is their single biggest asset. So when housing prices cratered, it hit household wealth directly, profoundly, and the bursting of this bubble, it nearly paralyzed the entire US and international financial system, led to a really deep, painful recession. The fundamental shift you're asking about, it was how mortgages were handled. The old way, maybe for decades, was originate and hold.
Meaning the bank that gave you the loan kept it.
Exactly. Banks kept the mortgages they wrote, which made them pretty careful about who they lent to, right? They verified your income, they required a decent down payment, they had skin in the game. But the new system became originate and distribute.
Okay, originate and distribute. So banks would write the mortgages, and then what? They didn't hold on to them.
Nope. They'd hold them for maybe just a few days, sometimes hours, before selling them on to investment banks. These investment banks would then bundle thousands of these mortgages together into complex products called mortgage-backed securities, or MBS.
Okay.
And then they sold these MBS pools to investors all over the world. Pension funds, insurance companies, you name it. It was sophisticated financial engineering, or maybe, financial alchemy is a better word.
Alchemy sounds about right. And these mortgage-backed securities, they were then sliced and diced even further.
Oh, yeah, into different tranches. Think of them like layers of risk. You'd have senior tranches at the top, mezzanine in the middle, equity tranches at the bottom. And here's the magic, or the danger. Even if the underlying mortgages were pretty low-quality subprime stuff, the top tranches could still get AAA ratings from the credit rating agencies, the highest possible rating.
How could that happen?
Through diversification and structure, supposedly, but the complexity didn't stop there. They created credit default swaps, or CDS. Think of CDS like insurance policies on these bonds. If the bond defaulted, the CDS seller would pay the buyer. AIG was a massive seller of these things.
So insurance, that sounds safe, right?
But here's the catch. The issuers, the sellers, like AIG, often didn't have nearly enough reserves set aside to actually pay out if things went bad. And even crazier, you didn't even need to own the underlying bond to buy CBS insurance on it. You could basically make a side bet that someone else's investment would fail.
So people were betting on failure.
Massively. This swap market ballooned to something like 10 times the value of the actual underlying mortgage bonds. It made the whole global financial system incredibly interconnected and far, far riskier than anyone realized.
It just sounds like a house of cards waiting to fall.
Mm.
What did all this demand for mortgages to package up do to lending standards? Were they loosened?
Drastically, utterly. If you're a lender and you know you're selling that mortgage off in a few days, you have much less incentive to care if the borrower can actually repay it.
Right, the risk is passed on.
Exactly. So we saw loans issued with zero down payment based entirely on the assumption that home prices would just keep rising forever. We even had NINJA loans. That stood for no income, no job, no assets.
NINJ loans, you're kidding.
Not kidding. And no DOC loans, where lenders didn't even bother to verify the borrower's supporting documents. Income, assets, just take their word for it. With money flowing this freely, home prices just soared. It became a self-fulfilling prophecy for a while.
And wasn't there also a role played by government policy in all this?
A significant one, yes. There was pressure from Congress to expand homeownership, which is a noble goal in itself. But it led to agencies like the Federal Housing Administration starting to guarantee mortgages for lower-income borrowers, sometimes with looser standards. By early 2010, studies showed nearly two-thirds of the bad mortgages originated during the boom were linked in some way to government agencies or regulations pushing for expanded homeownership.
So it wasn't just predatory lenders.
It wasn't just predatory lenders, though they certainly played a role. It was also government actions and policies that contributed to loans being made to people who, tragically, really couldn't afford to repay them long term. The incentives were skewed all around.
So just how big did this housing bubble actually get? How out of line were prices compared to history?
Well, look at the Case-Shiller Home Price Index. It adjusts for inflation, and it tracks prices across 20 major U.S. cities. For the 100 years before this period, inflation-adjusted home prices were remarkably stable. They didn't really go up much faster than overall inflation. But in the early 21st century, this index doubled. Inflation-adjusted prices doubled. In some hot markets, like parts of California, Florida, and Nevada, prices rose even more dramatically. It started looking strikingly similar to other bubbles. People weren't buying homes just to live in anymore. They were buying them to quickly flip for a profit, assuming prices would just keep going up.
And like all bubbles, eventually it had to burst. What was the fight out when this one finally popped?
The damage was just immense. Home prices fell across the board. In some of the hardest hit areas, they fell by two-thirds or more from the peak. Countless homeowners suddenly found their mortgages were way higher than the value of their homes. They were underwater. This led to waves of defaults and foreclosures. You heard about jingle mail, people literally just mailing their house keys back to the bank because they couldn't afford the payments and owed more than the house was worth.
It's heartbreaking.
It wiped out trillions in homeowner equity. It bankrupted major financial institutions like Lehman Brothers, Bear Stearns, required massive government bailouts for others like AIG. Credit completely dried up. Banks stopped lending. And that led to a really painful, protracted recession, the worst since the Great Depression in terms of its intensity and length.
So stepping back and looking at the big picture now, we've got the dot-com bubble, the housing bubble, different assets, tech stocks versus real estate. But they seem to share some common threads, don't they?
They absolutely do. A key lesson is that when bubbles burst, the real economy, jobs, spending, production, invariably gets severely damaged. And the harm is particularly bad when bubbles get tangled up with credit booms and widespread leverage. Leverage used by consumers taking out huge mortgages and leverage used by the financial institutions themselves. The U.S. experience in the early 2000s is a perfect illustration. Growing housing demand pushed prices up. Higher prices encouraged more mortgage lending, often looser lending, which fueled more demand and even higher prices.
That positive feedback loop again.
Exactly, fueled by easy credit and increasing leverage all around.
And then when the bubble bursts, that whole positive feedback loop violently reverses.
Precisely. Prices fall, wealth evaporates, mortgages go underwater, loans go bad, people get scared and cut spending drastically. Highly leveraged financial institutions, they scramble to deleverage, sell assets, reduce lending. This leads to a credit crunch, which further weakens the economy, resulting in a severe recession. The takeaway: bubbles linked to credit booms are profoundly dangerous to the real economy, much more so than maybe just a stock market bubble not fueled by debt.
Given all this craziness, all this irrationality, the massive destruction of wealth, does this just blow the whole idea of efficient markets out of the water?
You know, it's really tempting to think so. It looks like madness. But maybe the core lesson isn't that markets are perfectly efficient minute to minute. It's that they do eventually self-correct. Slowly, sometimes painfully, but inevitably. They tend to recognize true underlying value. As Benjamin Graham, the father of value investing, famously put it. In the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Voting versus weighing.
Yeah. Popularity versus substance. True value, which ultimately comes down to the present value of a company's future cash flows, that's what gets weighed in the end. It always prevails.
But how can markets be even remotely efficient if they make such completely bizarre errors? I mean, valuing dot-com companies as if they'd make profits in the afterlife, or the whole three-Palm Pilot absurdity, that seems like a massive market failure.
Look, market prices will probably always be wrong to some extent. Why? Because forecasting the future earnings, future cash flows, is incredibly difficult, maybe impossible to do perfectly, and figuring out the right discount rate to use is also really uncertain. However, the key insight of efficient market thinking, I think, isn't that prices are always right. It's that at any given moment, it's incredibly hard for any single person or institution to consistently know more than the market as a whole.
So you can't consistently outsmart the collective.
It seems not. Even the best and brightest on Wall Street, the hedge fund gurus, they can't consistently pick undervalued stocks or avoid overvalued ones year after year. There's just no consistent way to beat the collective wisdom or folly of the market by betting against it. You might get lucky sometimes, but consistently. The evidence says no.
Okay, what about the housing bubble then? People buying homes they clearly couldn't afford with NINJ loans. How does that fit with any kind of market efficiency? It just feels like the market was completely irrational.
That's a really fair challenge. But the housing market's collapse didn't necessarily destroy the efficient market hypothesis entirely, maybe because the incentives were so warped. Think about it from the individual borrower's perspective for a second. If you could buy a house with zero down payment, paying a somewhat inflated price might have actually been a rational decision for you.
How so?
Well, if prices kept rising, you made a profit on essentially zero investment if the bubble burst. You could just walk away, do the jingle mail thing, and leave the lender holding the bag. The losses weren't yours, they were the lenders or whoever bought the mortgage down the line.
So the downside was limited for the borrower, at least initially.
Exactly. The incentives were just completely abnormal. Regulation was clearly lax. So while it looked like madness, the housing bubble wasn't necessarily caused by blind faith in efficient markets alone. It was a complex mix of human psychology, greed, fear, perverse incentives, and, yeah, systemic regulatory failures.
So after diving deep into these two monumental financial bubbles, the dot-com crash and the housing crisis,
Yeah.
what's the single most important takeaway for listeners, for you and me, trying to navigate our own financial lives? What's the key factor in preserving and growing capital over the long haul?
It sounds almost too simple, but I genuinely believe it's the ability to avoid terrible mistakes.
Avoiding the big screw-ups.
Exactly. It's so obvious, yet so easily overlooked. That siren song of quick wealth, you know? It's
Okay.
fueled by hype, media frenzy, the fear of missing out, and it leads smart, otherwise rational people to make incredibly foolish decisions, like my friend with Boo.com.
Right.
Focusing on not losing big is maybe just as important, if not more important, than trying to win big.
So after unpacking the dot-com and housing bubbles, the common threads seem pretty clear. You've got this intoxicating mix of new opportunity, whether it's the internet or new mortgage products. You've got basic human psychology, greed, fear, herd behavior, and often some misguided financial engineering thrown in. But reflecting on all this, what stands out most to you from these deep dives?
For me, it really comes back to the enduring power of Ben Graham's wisdom, that idea of the market as a weighing machine. It might take time, sometimes a painfully long time, but eventually the market does weigh the substance. It figures out the true value. So the real question for every investor, for everyone listening is, do you have the discipline, and maybe more importantly, the patience, to wait for that true value to emerge? Or are you going to get caught up chasing the fleeting illusion of some get-rich-quick scheme?
That's a powerful thought. And it raises a really important practical question. If the market is ultimately a weighing machine, how do you actually go about estimating that true underlying value? How do you weigh the substance? Well, we'll be diving into that very question, the tools and techniques for valuation, in our next deep dive. And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.